So let me start by just showing to you a very very pertinent quotation from the late Sharad Joshi. For those of you who don't know Sharad Joshi, he used to be leading, I mean, how can you describe him? He was an activist, a farmer champion, an economist. He was a champion and leader of the farmers, and somebody who was significantly ahead of his time. Even in sort of 1960s, 1970s, he used to have movements that used to talk about markets and giving market access to farmers, which in those days, 1960s, 1970s, was completely an idea whose time then hadn't really come, and it was way ahead of his time. So one of the things that he very pertinently observed is that is talking about the degrees of freedom an individual enjoys. And I'm going to start, and he obviously specifically talked in the context of the degrees of freedom the farmer enjoys, because he spent his life representing the cause of farmers. And I'll sort of talk about how that very simple but powerful quotation of his is very relevant today, and how the changes that we are seeing today are basically going to sort of satisfy what he wanted to see happening way back. So just apologies for the small print type on the slides, but I'll talk through it so you can just stay focused on my talks, and if you miss something, then the print is there always. So the Indian agricultural sector economy is, I'll just talk about the state of the current spot markets in the country. Indian total annual agricultural production is about 9 lakh crores. So primary produce in India of agriculture is about 9 lakh crores. And that is brought to markets by farmers. So roughly 60 million farmers, 300 million farmer families. That is brought to the market in about 7,000 markets in the country. These markets are what is called as mandis or APMCs, Agricultural Produce Marketing Committees. APMCs stroke mandis is the sort of the backbone of the current agricultural marketing infrastructure in India, and there are 7,000 of these. Agriculture, as we all know, is a state subject in India, and they are governed by what is called as the APMC Act, the Agricultural Marketing Produce Committee Act. And that act, every state has an act. Some states have repealed that act, done away with that act, but most states even today have that act, and that act is a pretty old act. The government of India, central government, has passed a model APMC Act. Many states are in the process of adopting or fine-tuning their local acts to be in line with the model APMC Act issued by the government of India. So that is the governing piece of legislation, the APMC Act. Multiple grades for every commodity. There is absolutely no standardization in agricultural produce today. Just to give you an example of rice, there are at least 50 price points ranging from 1,200 rupees a quintal to 6,000 rupees a quintal in just rice. And even within these 50 price points, there are sub parameters that have further price relevance in rice. And I'm just giving you a simple example of rice. So when you say what is the price of rice in the country today, it is impossible to say what is that one single price of rice, because there is no standardization, there is no standard grading, there are multiple varieties, there is no national level of grading standards that have been created, and that creates a huge problem for both the buyer and the seller, and more so for the seller, because the seller is a marginal farmer, and if the output that he's producing is not standard, then he or she is disadvantaged the most, and that lack of standardization, the advantage of lack of standardization is often taken by the buyer and the consumer. So this is a huge problem at the moment. So this is sort of the lay of the land. I mean, there are multiple other problems, but this is current state of spot markets. Some attributes, I talked about the 7,000 markets. These 7,000 markets are disconnected markets. So they are, there's no connectivity between each of these markets at the moment. They exist spread out amongst all the states in the country, and all the traders in these markets have to take market-wise license. So as a trader, if I would like to participate in any of these markets, I have to take a market-wise license for me to have participation access in that market. So technically, if I want to participate in all 7,000 markets, I need 7,000 licenses in the country. So that's the state of play in terms of how complex it is to operate and to create a marketing infrastructure. The farmer is one unique entrepreneur who buys all his stuff in a retail market. So he's exposed to the vagaries of a retail market, retail price when the farmer buys. It could be inputs that he buys, fertilizer, seeds, anything else. And when he goes out to sell his final product, he sells wholesale. So it's a most great businesses or good entrepreneurs will want exactly the reverse, right? You want to buy wholesale, sell retail, so that you can get the price benefit. But the farmer is exactly at the other end of the curve, exactly inverse economic sort of situation of the farmer, where the input buying is at a retail price and the selling is wholesale. All these 7,000 markets, as I mentioned, are very geographic centric. So once a farmer comes to a particular market, which usually will be about 50, 75, 100 kilometers away from farm gate, then there is no going back. For that farmer, the farmer has to sell, because it costs the farmer to bring his produce to a market which is 100 kilometers away, and there's no chance of him taking that material back and coming after a few days again to resell, to have another crack at selling the produce in the market. So they're very geography centric markets, and activity is centered around that specific geography. Typically, the roles of the buyer, the creditor, and the regulator are all very mixed up in the market, and that's one of the biggest challenges in the market. So usually, the buyer will end up giving credit to the farmer, and once the farmer gets into a credit trap from the buyer, the farmer is just at the whims and fancies of the buyer, and caught in that sort of endless loop of having to constantly go back to the same buyer, because there is a credit relationship which is embedded in that in that transaction. The regulator, which is supposed to be the APMC committee or the market yard committee, is usually dominated by the traders, local politicians. So the buyers themselves tend to be sitting as regulators, forming rules, regulations, and forming the sort of the standard operating procedures for how that market works. So obviously, most of the regulations that operate in the market are biased towards the buyer. So that's another big challenge as far as these markets are concerned. There is no notion of any quality-based sale that happens in the marketplace. The typical sale happens when a farmer brings his produce and dumps it as a heap on the floor, and the trader will come through visual inspection, sense the quality of that produce and quote a price to the farmer. And the farmer obviously has no choice, because he has no clue what the quality is and what is the marketable value of that quality. So the farmer is completely reliant on the assessment of quality by the trader and the valuation of that quality by the trader. So there is absolutely no scientific quality based sale that happens in that marketplace. So these are the challenges of the current spot markets. As one can imagine, they are pretty broken, to say the least, and very disadvantaged to the producer, which is to the farmer. And this has been going on for many years, ever since the market started. Some states have recognized the problem with the spot markets, and they have repealed the APMC Act. So they have done away with the APMC Act. For example, Bihar is one such state where the APMC Act has been repealed, done away with. However, they have not replaced it with any alternate market structure. So it's actually gone from bad to worse in Bihar. there was at least some semblance of a market, though broken, though dysfunctional. There was at least a market where some marketing activity could happen. Having repealed the APMC Act and not having substituted that with an alternate marketing model, it has gone from something to nothing. And that has put the farmers to even more disadvantageous situation. So in general, there has been a challenge as far as spot markets are concerned. So this is the lay of the land as far as current spot markets are concerned. I'll move to how the futures markets operate currently. So I'll jump from spot to futures, and then I'll slowly build the linkages between the spot markets and futures markets, and what is going on currently in the landscape in the country. NCDEX is, as I mentioned earlier and as Prashant mentioned earlier, the largest agricultural produce centric commodities exchange in the country. We have about 90% sort of market share as far as agricultural derivatives trading is concerned. We trade about 25 commodities in futures. There's only one instrument, one type of instrument that's allowed in commodity derivatives today, which is futures. So it's a highly simplified market structure currently in the derivatives landscape, which is only futures are allowed to trade. However, with this limitation and with this limited sort of mandate and landscape, we have been able to create benchmark prices across the country, and we've ended up sort of creating the barometer of price as a barometer for all these 25 commodities that trade on NCDEX. The annual turnover for us is 10 lakh crores. Open interest is 5,000 crores on a daily basis. So it's still fairly underdeveloped, a huge headroom to grow and develop these markets. It's fairly shallow, quite small, lot of opportunity to grow. But that's the state, that's the state of play as far as futures markets are concerned. Some attributes of the futures market. We have been able to create a single national market, and a national price has now been established for at least 50% of food grains, pulses and spices. So that's quite a substantial achievement. These markets have been around for roughly 13 years. The commodity exchanges were set up in 2003, and since then they have been active. The price discovery happens on futures exchanges. As we know, futures is a highly standardized instrument. Futures do price discovery for a very standard specification. They expire on a very specific date every month. So it's a very standardized instrument. So for that specific quality of that commodity, price discovery happens on a national basis, around which now the rest of the grades have started to price themselves. So like I mentioned, rice has more than 50 sort of price points, and rice unfortunately has been suspended from trading on futures markets. But in most other commodities that trade on futures, all the grades that are above or below the futures grades trade off the futures price. So either as a premium discount on the futures price. So that has helped the farmers and the various value chain participants to get a reference point around how they buy and sell these commodities. So the futures prices have now acted as benchmarks, because in the absence of an active spot market or a well-functioning spot market, futures are the only benchmark that's available in the market. So even today, if you travel in the APMCs, in the markets, talk to farmers, they may not know them as futures, what is locally in the physical markets known as dabba. So if you ask anyone, what is the price on a dabba, they're basically talking about the futures price. And the dabba price is basically very, very well known and well published and well disseminated in the market today, and the whole market now trades around the price on the dabba. So from a branding perspective, not a great sort of brand recognition for futures, but it is what it is. The main sort of takeaway there is that the futures prices have influenced price discovery that happens in the physical markets, and that's, I think, a big takeaway. So the indirect benefit to the farmers has been quite substantial from the futures prices. It is right from day one, unlike the securities market, which started off as open outcry, floor-based trading, trading and pit-based trading, and then subsequently moved to electronic trading. Futures markets from day one have been electronic markets. So they've been able to sort of leapfrog and start on day one with an electronic infrastructure. Most of the futures price discovery happens through compulsory delivery contracts, which is an important nuance to understand, which means that at the time of expiry of the futures contract, whoever is still standing at the end of that contract on the day of expiry, as a seller has to give physical delivery, and as a buyer has to take physical delivery of that commodity. And that, though cumbersome and though tedious, because managing physical commodities is quite a cumbersome and tedious process, however, that nuance ensures that on the day of expiry, 100% convergence of spot markets and futures markets happens. And that is an extremely important attribute of today's futures markets, that every 20th of every month, which is when the futures contract expires every month, there is a 99.9% convergence. The reason I don't say 100% is because there are costs of bringing commodities into the warehouse, which will result in a slight difference between the actual spot price and the settlement price on futures. But barring that difference, there is a 99.9% convergence between spot prices and futures prices. Now that is a pretty significant achievement for the futures markets, gives a lot of credibility to hedgers, value chain participants, policymakers, farmers. So that's an important attribute of the futures markets. The sort of a side benefit of the futures markets has been the development and evolution of the warehousing sector, especially in the private sector. Prior to the futures markets developing, the main warehousing activity was in the public sector warehousing with State Warehousing Corporation, Central Warehousing Corporation, Food Corporation of India. Most of the warehousing capacity was with these bodies. But the private sector warehousing was typically in the form of small godowns owned by traders. They were not really in the form of private sector companies and sort of well capitalized, well governed private sector warehouse service providers. That development has largely happened when the futures markets came into being, and today the landscape is developing quite well. We have at least 10 to 15 reasonably well governed, well capitalized private sector warehouse service provider operators who have now developed. They are attracting good amount of capital, so the capital is beginning to flow into that industry, and that industry is beginning to develop. So almost out of 100 million metric tons, which is the total warehousing, roughly the warehousing capacity in the country, about 40% is held now in the private sector. So 60-70% is still with public sector, but about 40% is held in the private sector. So that is a good sign of how the underlying infrastructure of the agri markets is developing, because warehousing is a essential plumbing for agri markets to develop. Unless you can store goods in a scientific manner, in a trustworthy manner, marketability is always going to be a challenge. So that is one big sort of takeaway. The other big takeaway is that, at least as far as exchange warehouses are concerned, we have created an electronic, a version of an electronic warehouse receipt, which indicates a transparent real-time stock inventory of all the stocks that are there in warehouses. We are now obviously working with the WDRA to see whether that small concept can be created into a national level repository for warehouse receipts, and I'll talk a bit more about that in my future slides. So that's the current futures market attributes. So the question to ask is that is it all perfect? Is where we stand today as far as futures markets are concerned, is everything on the right track? And the answer is that we've got a long way to go before we develop this market even further. Significant long way. So globally, if you see, the open interest to production ratios. So open interest is one of the key metrics that are used to measure the health and success of derivatives exchanges. Open interest is basically the amount of open positions that are there for the derivatives contract at the end of every day in the derivatives exchanges. So the amount of open interest as a ratio of the production of that underlying commodity in most global exchanges is between 25 to 40%. In India, in some exchanges, it's even more than 40%, but the averages are roughly around there. In India, in most commodities, it is less than 1%. Which just shows the amount of headroom that is available to grow, and it's still a very nascent, the derivatives markets are still very nascent. The participation is also very limited to a few hedgers and a few speculators, and price discovery is often affected by things like Essential Commodities Act, Food Safety Act. The public perception of commodity markets is still that this is just dominated by a bunch of speculators. So if that is by and large, unfortunately, the public perception of the markets. And these markets, because of how sensitive the agri sector is to the country, because of food inflation, food security, it is very tightly regulated as well. Because the spot markets are regulated by the states, and the derivatives markets are regulated by SEBI now, there is also a difference between how the regulation happens. So unlike securities markets, where the spot markets and the derivatives markets are both regulated by the same regulator, which is SEBI, in the case of agricultural markets, spot markets are regulated by the state, and actually not really well regulated by states, but still the regulatory mandate is with the states, and the derivatives market are regulated by SEBI. So there are a lot of imperfections in the market, and I just wanted to talk about where we stand as far as the evolution of the markets are concerned. Having sort of painted a bit of the landscape as to how the spot markets exist and how the futures markets exist, I'll move to the next part of my talk, which talks of the integration between these markets. So in the good old days, so I'll start to talk about the spot futures integration. In the good old days, the market, physical market, used to be characterized by a few stockists. So every commodity in the local physical market would comprise of a few stockists. They would buy from the farmers spot, and they would stock, and they would sell that in the future, not in the futures market, but in the physical market. They would forward sell to the processors like ITC, Adani, Ruchi, sugar companies, and so on and so forth. They would sell the produce to them. So that would be the only linkage between the spot markets and the forward markets in the good old days. When the derivatives exchanges came on the scene over the last 10 years or so, especially through warehousing and the demat creation, so the electronic entry of a warehouse receipt, that democratized the holding of stocks in a warehouse. Earlier, because of the complexity and the tediousness associated with bringing stock into a warehouse, depositing in a warehouse, it used to be the sort of the domain of only the stockists and the traders who knew how to work around this system, right? Now, with the exchanges having created a fairly democratic platform and an electronic demat mechanism for holding stock in a warehouse, where you physically don't need to see the stock in the warehouse. You can be sitting in Bombay, but hold demat stock in a warehouse in Alwar in Rajasthan, as an example, and be assured that the quality and quantity is taken care of by the exchange ecosystem. That has created the emergence of what is called as the cash and carry investor. A huge sort of emergence of a small cash and carry investor has come up in the derivatives market, and these cash and carry investors minutely arbitrage out the differences between spot prices and futures prices. So even small differences between spot and futures prices get arbitraged out by these cash and carry investors, and this has over the last many years ensured that the spot and the futures markets start to move closer and closer to each other, the price discovery, because anytime there is a significant difference between spot markets and futures markets, the arbitrageurs will jump in and arbitrage out the differences and bring the two prices closer to each other, at least at the expiry of the futures contract. So that integration is happening quite well from a price discovery perspective. However, as I mentioned earlier, it still applies to very few commodities and very few grades, and hence that benefit is not enjoyed by a large cross section. That arbitrage benefit is still exploited or arbitraged out by traders, by cash and carry investors. So the farmer actually still hasn't got the benefit of that integration to the extent that that should have happened by now. However, because the futures prices converge quite strongly with spot, there is quite a strong correlation between spot prices, futures prices, and if sometimes spot market runs away and significant price rise happens, there have been instances when futures markets have brought them back and ensured the correction, and vice versa. So the futures markets have demonstrated runaway increase, not explained by fundamental factors. Then the arbitrageurs have been able to drag the futures market back in order to ensure convergence. So there is a degree of integration that is available, but the challenge is that it's available only to a few limited participants and to a wider range of public and farmers, processors and consumers and producers. It's still that concept of integration is still very alien to that community. So a lot more needs to happen as far as spot futures integration is concerned. So what does the landscape look like going forward? So I'll start to talk about what we are seeing, what I am seeing in terms of the change in regulatory landscape across a variety of aspects. So what are the game changers? State agri markets, what I call as SAM, the Karnataka model, I'll talk briefly about that. Warehouse based sales, and the recent announcement by the Honorable Prime Minister to launch the concept of the National Agri Market called as ENAM. Now, I think are big substantive game changers in this industry. So I'll take you back to a small experiment that was carried out by NCDEX in December of 2011 in a small market called Gulbarga in Karnataka. So we went to Gulbarga in Karnataka and said, how would you like to automate, modernize and make your physical APMC markets, which are quite dysfunctional as I described earlier, and convert them into a more modern electronic market. And we just approached the Gulbarga APMC committee members, and they said, fantastic, why not, let's start a pilot project. And that pilot project went on for about a year and a half, and it was extremely successful. That pilot project then inspired the state government of Karnataka to say, why don't we replicate that across the state? And that now is called as the Karnataka model of agri marketing reform. It was in fact even mentioned in the 2014 economic survey of the government of India, where the Karnataka model found mention in the economic survey, and that formed the inspiration behind the National Agri Market project that Honorable Prime Minister has launched. We believe that these models where state agri markets are now getting integrated, national agri market, the concept, the notion of a national agri market is now being floated, and work has started with the right sort of enthusiasm, are going to be game changers as far as the agri markets are concerned. Of course, long way to go, but these are game changing things that are happening at the moment. GST, a piece of legislative infrastructure which hopefully will happen in the next few months, maybe a few years, but whenever it happens is going to be a game changer, but because it will enable free movement of agricultural produce across the country. So even if you create an electronic national agri market, the fact that there is restricted movement of agricultural produce across markets and a plethora of taxation, right from octroi, VAT, sales tax, etc., it makes it impossible for agricultural produce to move from one state to another state. It does move, but it moves at a very high cost and extremely inefficiently, and that actually results in eventual inflation, because the difference between wholesale prices and retail prices for agricultural produce in many instances is close to 100% or even more. And that gap can only narrow if the movement of goods from from surplus states to deficit states can happen in a more seamless manner. So GST as a piece of legislative infrastructure will be a game changer. The other piece of game-changing initiative is something that maybe respected Chairman WDRA can talk about later on, is the notion of a national commodities repository, for which some work is going on, and it's literally going on probably partially in this building as well, with leadership of WDRA, which is the equivalent of NSDL CDSL for the securities markets. So if you just jog your memory back, the kind of impact that NSDL CDSL had on the equity markets when they got formed through sheer movement away from paper-based shares to a demat, holding of shares in NSDL CDSL, and it had a sort of, it had a significant game-changing effect on growth in equity markets. I believe that kind of game-changing effect can happen to the agricultural markets when a repository or a few repositories are up and running, and they create the concept of an electronic negotiable warehouse receipt or an electronic warehouse receipt. Once that concept is established, the trust in that instrument will grow quite significantly, and the whole value chain of farmers' trust in that instrument, lenders' trust in that instrument, the bankers' trust in that instrument, the traders' trust in that instrument will go up quite significantly. And my belief is that then the agricultural market will start to behave more like modern. They will demonstrate the attributes of a modern marketplace. So that is another game-changing piece of legislation that is likely to happen. The other game-changing moment was in September of 2015 when the SEBI FMC merger happened. SEBI, as we all know, is a tier 1 world-class regulator, and the confidence, the trust, the image that SEBI has in the marketplace will rub off significantly on commodity markets. And as and how SEBI settles down, understands, gets its sort of teeth sunk into the commodity markets and initiates the roadmap for development of these markets, this will create a huge amount of confidence for investors, participants, traders, hedgers, for their participation in this market. So I do believe that that's also a pretty game-changing sort of initiative. And the last but not least is the emergence of producer companies. So as you know, the agricultural market has also been characterized by thousands and thousands of small cooperatives, cooperative societies that have been around for many years. These cooperative societies have in some cases proven benefit, but in most cases not been very relevant institutional mechanisms to actually help farmers aggregate their produce or aggregate their demand. The Companies Act in early 2000 went through a modification where producer companies were encouraged under farmer producing companies and farmer producer organizations, and an amendment to Companies Act was made to recognize, to enable the creation of producer companies. And today we have about 1200 producer companies in the country, where farmers are shareholders in the producer companies. And it's still a very new concept, extremely new concept, but we are working with almost 30-40 producer companies in the country, and we are helping them get connected to the markets. And these producer companies behave like a modern day organization. They are under the Companies Act. They have a CEO, they have a compliance officer, they have shareholders, they have farmers as shareholders. They are behaving as modern day corporates, representing the interests of a small and marginal farmer. And although it's a very early days, but I believe that these producer companies will act as very powerful aggregation points for farmers in the years to come. So roughly, we believe that these sort of these few initiatives that I have just outlined, and there may be several others, but these are big ticket game-changing items. So if you sort of fast track and fast forward our clock to 5 years from now, I would imagine that most of these initiatives would be well on their way in terms of creating new market infrastructure, and they would I think have a significant effect on the development of agricultural markets. So what are the big ideas that I think will come out of these game-changing market infrastructure initiatives? Warehouses will become a very strong integration point between spot markets and futures markets. If we can get a farmer to bring his or her produce to a warehouse and then give that farmer the choice, the degrees of freedom that Sharad Joshi talked about, the late Sharad Joshi talked about, which is to sell across time, across the time axis. So if the spot prices are great, let me sell spot. If the forward prices are great, let me have the ability to store the produce and sell it at a futures price. That can only happen if there is storability of that produce. So the warehouses as an integration point between spot and futures markets is going to be quite a big idea. It will develop very strongly. Interoperability between state markets, ENAM and futures is another sort of big idea that will come, and it will create the sense of a truly well integrated national agri market structure, which will give farmer the choice. Dematerialization of all warehouse receipts, as I talked earlier, through the creation of a national repository. Options as an alternative to the minimum support price program, which is also a very powerful idea. Today the government spends almost 1 lakh crores of valuable public money in the minimum support price program, and the minimum support price program really affects just 2 or 3 commodities in the country and 2 or 3 states in the country. So so you could very effectively replace the entire minimum support price program through a market instrument, which is an options instrument. And even if the same amount of money of 1 lakh crores was used as a subsidy to fund the farmer premium, assuming the farmer is a buyer of a put option, and the premium is paid by the government, and that 1 lakh crores is used to pay the premium, the reach would go to almost each and every farmer, up and down and the length and breadth of the country. So the options as a substitute to the minimum support price program, I think, is a very powerful idea. Location specific contracts, futures contracts, grade specific futures contracts, and interconnected through spreads, trading spreads, will ensure that we are able to attract more and more agricultural produce to the markets. So just some brief ideas. I mean, a lot of them have tons and tons of detail underneath them, and this may not be the the best vehicle for getting into those detail, but I'll just throw those ideas on the table. So in my view, the result of this, in very simple terms, that it gives the farmer the freedom to sell across 3 degrees of freedom: location, grade and time. And that, I believe, is a very powerful idea. So if we can champion the cause of giving the farmer the access to 3 degrees of freedom, which is to sell his or her produce across location, across grade and across time, I think will be a hugely liberating moment for the farmer, and and will result in truly the integration between spot markets, futures markets, and create a vibrant and a robust sort of agricultural market driven economy for the country. So what's the price? Why is this all worth it? It's all technical language, market jargon, etc. At the end of the day, it has to have economic benefit, socio-economic impact to the stakeholders and to the country. We believe that this can go a long way in doubling farmer income by 2022, which is one of the strong objectives of the current government. It could go a long way in addressing food security issues. It could go a long way in addressing price stabilization. Just from a market perspective, the open interest, even if you take open interest to get to a 10% of production, as I mentioned earlier, the open interest in India today is less than 1%. Global averages are 25 to 40%. If you just take over the next 5 years, assume that a 10% open interest is created out of production, you're talking of 50,000 crores of open interest as compared to 5,000 crores today. So a 10 times development of the commodity markets, the derivatives markets. I'm not even considering the impact of options. And the opportunity to benefit Indian trade by becoming price setters. So once you have liquidity and the price of wheat, corn, bean, spices, pulses, once they get discovered and set in India, from a trade perspective, we start to become price setters, and that has a knock-on effect on on various other aspects. So this is the price, if we get this right. I think it's quite it's quite a compelling sort of proposition to aspire for. What are even after the game-changing ideas and the big ideas that I talked about, what are the problems still remaining to be solved? The grade standardization, there is very little work that is still going on in grade standardization. So there is a need for advocacy, public commentary, debate, discussion around grade standardization, common clearing across spot and derivatives markets. Things like the Essential Commodities Act and Food Safety Standards Authority of India, those are still still very, food safety standards obviously very relevant, very current, but it needs to be implemented. Today, for example, the farmer as a producer is exempt from food safety standards. So if a producer is exempt from food safety standards, how can we expect the end product to be compliant with food standards when the producer himself has no, is outside the legal ambit of food safety? Essential Commodities Act, in my view, is a pretty arcane concept. It needs to be, replaced by more transparent and more, by the national repository, as and when WTRA is able to, pull that off. That I think will give transparency of stocks in warehouses and will give the comfort to the government that all stocks in warehouses can be transparently, sort of tracked. And at that point in time, things like essential commodities hoarding will become concepts of the past. Perception and risk of overregulation still continues to exist. Common KYC across markets, information asymmetry. These are some of the big problems that still remain to be solved. One simple example I'll give you of soya bean, which is quite a compelling example. This is last season forecast in December of 2015. 4 different sources of forecast for soybean production for the last season. SOPA said that the production is 73 lakh metric tons. Government of India's estimation was 106 million metric tons, 106 lakh metric tons. USDA forecast was 73.8 and the market's forecast was 65. In this context, what kind of decision making can prevail, what kind of price discovery can happen, is, I leave this as an open question, but it just goes to indicate that in a market where there is so much information asymmetry, there is no room for efficient price discovery for the 60 million farmers in this country, or for the hedgers or for traders. If the gap is so much, then how can you have an efficient market structure? So there are still some big problems to be that remain to be solved, and I just wanted to put them out there. I'm sure through more seminars like this, public debates, discussions, more of these topics will find their way into legislation, policy support, and initiatives by the various government and regulatory authorities. So that's really my sort of presentation for today. My ask of you is that this room is represented by regulators, researchers, analysts, and a variety of sort of stakeholders, is for you to be aware of what's going on in the marketplace, look at the price, and get connected. I mean, this is a cause worth fighting for. It has a significant positive impact on socio-economic aspects, and whatever role each one of us play. If you're an analyst writing about it, if you're an economist putting up papers, if you're a journalist sort of writing about these issues, these opportunities, if you're a regulator, then obviously policy support. So each one of us has a role to play. That's my ask of all of you. With that, I'll stop my sort of monologue as far as this topic is concerned, and leave it open to questions and answers. I hope this has given you a sort of perspective of what is the state of play as far as these markets are concerned. Thank you very much.